Imagine this. You're sitting on a white sandy beach, sipping a cold drink and watching the sunset over the horizon. Sounds like a dream, right? Well, what if I told you that investing could be your ticket to turning that dream into a reality? Today, we're diving deep into investing to unlock the secrets of building wealth. Get ready to discover how to maximize returns and minimize risks in this captivating journey to financial freedom. Investing is the art of putting your hard-earned money to work for you. It goes beyond simply saving your money in a bank account. The purpose of investing is to grow your wealth over time by allocating your funds to assets that have the potential to generate returns. Whether stocks, bonds, real estate, or other investment vehicles, the goal is to make your money work harder and smarter for you. Investing involves taking calculated risks in the pursuit of potential rewards. By carefully selecting and managing your investments, you can aim to earn profits through capital appreciation, dividends, interest payments, or rental income. It's important to note the distinction between saving and investing. Saving involves setting aside a portion of your income for future use, typically in low-risk, easily accessible accounts like savings accounts or certificates of deposit, CDs. On the other hand, investing focuses on using your savings to generate higher returns over the long term, usually by accepting a certain level of risk associated with the chosen investment. One of the most potent factors in investing is the magic of compounding. Compounding refers to the ability of your investment returns to generate additional returns over time. Starting early gives your investments more time to compound, resulting in exponential growth. Let's illustrate this with an example. Suppose you start investing $1,000 monthly at 25 and continue until you reach 65, assuming an average annual return of 8%. By the time you retire, your investment will have grown to an impressive $2.3 million. However, if you delay your investment journey and start at 35 instead of 25, even with the same monthly contributions, your total at retirement would only be around $1.1 million. That 10-year difference in starting early made a staggering over $1 million difference. Statistics consistently demonstrate the benefits of investing early. Historical data shows that the stock market, for example, has delivered an average annual return of around 7 to 10% over the long term. By harnessing the power of compounding and giving your investments more time to grow, you increase your chances of achieving your financial goals, such as buying a home, funding your children's education, or enjoying a comfortable retirement. Remember, time is your greatest ally when it comes to investing. So don't delay. Start investing as early as possible and let the magic of compounding work in your favor. To maximize returns and make the most of your investment journey, it's crucial to set clear financial goals. Your goals act as a roadmap guiding your investment decisions and providing a sense of purpose. They can be short-term, 1 to 3 years, medium-term, 3 to 5 years, or long-term, 5+ years. Short-term goals may include saving for a down payment on a house or planning a dream vacation. Medium-term goals could involve funding your child's education or starting a business. Long-term goals typically revolve around retirement planning and building substantial wealth over time. I encourage you to take a moment and define your own investment goals. Be specific, measurable, and realistic. A clear vision of what you want to achieve financially will help you stay focused and motivated throughout your investment journey. Diversification is a powerful strategy to maximize returns while minimizing risks. It involves spreading your investments across different asset classes such as stocks, bonds, and real estate. By diversifying, you reduce the impact of any single investment on your overall portfolio. The benefits of diversification are twofold. Firstly, it helps mitigate risks. While one investment may underperform, others in your portfolio may deliver better results, creating a balance. Secondly, diversification increases your potential for higher returns. By having exposure to different asset classes, you position yourself to capture gains from various market opportunities. For instance, you have a portfolio of stocks, bonds, and real estate. The stock market may decline during an economic downturn, but your bonds and real estate investments could provide stability and generate income. Conversely, during a bull market, stocks may outperform other asset classes, contributing to significant growth in your portfolio. Choosing suitable investment vehicles that align with your goals and risk tolerance is essential when maximizing returns. Here are some commonly considered options. Investing in individual company stocks allows you to own a portion of the business and participate in its growth. Stocks can offer high returns but also come with higher risks. Bonds are debt instruments where you lend money to governments or corporations in exchange for regular interest payments and the return of principal. They are considered less risky than stocks and provide a predictable income stream. These investment vehicles pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They provide instant diversification and professional management. Index funds track specific market indexes, such as the S&P 500, and aim to replicate their performance. They offer broad market exposure and low fees, and can be a suitable option for long-term investors. It's essential to thoroughly research and understand each investment option's characteristics, advantages, and risks. Consider factors like fees, historical performance, and the level of risk you're comfortable with. Tailor your investment choices to your specific goals, time frame, and risk tolerance. Investing is a personalized journey, and what works for someone else may not necessarily work for you. Take the time to evaluate your options and seek professional advice if needed. Selecting suitable investment vehicles increases your chances of maximizing returns while minimizing risks. Risk refers to the uncertainty or potential for loss associated with an investment in investing. It's essential to recognize that all investments come with risks. Understanding risk is crucial because it helps you make informed decisions and manage your expectations. Personal risk tolerance plays a significant role in investment decisions. It refers to your ability and willingness to endure fluctuations in the value of your investments. It's vital to assess your risk tolerance honestly, as it varies from person to person. Age, financial goals, income stability, and emotional temperament influence your risk tolerance. The relationship between risk and potential returns is often characterized by the principle of higher risk, higher potential returns. Investments with higher risks, such as stocks, have the potential for greater returns but also carry a higher chance of loss. Conversely, lower risk investments such as bonds or cash offer more stability but typically deliver lower returns over time. Asset allocation divides your investment portfolio among different asset classes to manage risk. It is a fundamental strategy for minimizing risks. By diversifying your investments across asset classes like stocks, bonds, and real estate, you can reduce the impact of any single investment on your overall portfolio. Different asset allocation strategies are available based on your risk tolerance. A conservative allocation focuses on preserving capital and prioritizes lower-risk investments like bonds and cash. It aims to provide stability and income suitable for individuals with a low tolerance for risk. A moderate allocation strikes a balance between risk and return. It combines a mix of stocks, bonds, and other assets, seeking both growth and stability. This approach is appropriate for those who can tolerate volatility in pursuit of higher returns. An aggressive allocation is geared towards long-term growth and involves a higher concentration of stocks and riskier assets. This strategy suits individuals with higher risk tolerance and a longer investment horizon. Consider your investment goals, time horizon, risk tolerance, and financial circumstances to determine an appropriate asset allocation mix. It's wise to periodically reassess your asset allocation as circumstances and market conditions change. Before making investment decisions, conducting thorough research is vital. Reliable sources of information can help you evaluate potential investments and make informed choices. Some sources to consider include financial news outlets, reputable investment websites, and regulatory bodies. When researching investments, it's essential to analyze financial statements, evaluate company fundamentals, and assess market trends. Look for key financial metrics like revenue growth, profitability, debt levels, and competitive advantages. Consider the company's management team, industry dynamics, and macroeconomic factors that may impact the investment's potential. Additionally, keep in mind that past performance is not a guarantee of future results. Evaluate investments based on a long-term perspective rather than short-term fluctuations. By conducting thorough research, you enhance your understanding of investments and reduce the likelihood of making impulsive or uninformed decisions. It's wise to consult financial advisors or professionals for guidance and support in navigating the complex investing world. Remember, minimizing risks requires a combination of understanding risk tolerance, diversifying your portfolio through asset allocation, and conducting thorough research. By implementing these strategies, you can mitigate potential risks and increase the likelihood of achieving your investment goals. In conclusion, we have explored the essential elements of maximizing returns and minimizing risks to build long-term wealth through investing. We began by understanding the basics of investing, recognizing its purpose and the difference between saving and investing. We then highlighted the importance of investing early, harnessing the power of compounding to impact wealth accumulation over time significantly. To maximize returns, we discussed the significance of setting clear financial goals, diversifying your portfolio, and selecting suitable investment vehicles that align with your objectives and risk tolerance. By diversifying across different asset classes and conducting thorough research, you can minimize risks while increasing your potential for higher returns. Finally, we want to emphasize the importance of taking action and starting your investment journey today. Building wealth requires discipline, patience, and continuous learning. Take the first step and seek further education to enhance your investment knowledge. Stay updated with market trends, explore different investment options, and consider consulting with professionals to make informed decisions. Investing is a personalized journey, and what works for one person may not work for another. Evaluate your goals, risk tolerance, and financial circumstances to tailor your investment strategy accordingly. By maximizing returns and minimizing risks, you set yourself on a path toward long-term economic success and realizing your dreams. Now is the time to embark on your journey to financial freedom through investing. Start small, be consistent, and let the power of compounding and intelligent investment decisions work in your favor. May your investments flourish and your wealth grow steadily as you navigate the exciting world of building long-term wealth through investing.